Professional Indemnity, or PI insurance, covers the cost of potential claims and disputes arising from a third party alleging a breach of professional duty. PI cover is mandatory for holders of an Australian Financial Services licence under the Corporations Act 2001. ASIC, in its Regulatory Guide 126, Compensation and Insurance Arrangements for AFS licensees, stipulates the minimum requirements for PI insurance, including the amount of cover, scope of cover, exclusions and persons covered. In this session, we'll explain the basic elements of PI insurance cover, discuss the regulatory obligations for financial advisors in relation to PI insurance, and describe common insurer exclusions in PI insurance policies. Michael Pollock presents this report.
PI insurance is designed to protect the insured against legal costs and damages brought by third parties alleging a breach of professional duty. The ramifications of a claim against a business can be significant and long-lasting, regardless of the extent of the actual breach, or even if there was no proven definite breach at all. Possible impacts on the business include loss of reputation, disruption to business operations, legal costs, and bankruptcy. Legal action often seems like a remote possibility but can arise quickly from unforeseen events. Within the realm of financial advice, PI insurance is a compulsory requirement. Applicants for an AFS licence must confirm that they have adequate PI insurance cover in place at the time of making the application. The objective of this insurance is to ensure that all losses suffered by clients as a result of misconduct or inappropriate advice made by AFS licensees or their representatives under the Corporations Act can be paid. Mega Capital Insurance Brokers Eleanor Miller explains that PI insurance is an effective way to transfer liability, given that successful PI claims generally provide compensation for loss caused to the claimant.
Professional indemnity insurance isn't intended to be a consumer protection mechanism, and so effectively what it's there for is actually to protect the insured. The compensation for the claimant's costs in bringing the action, as well as the insured's defence costs in defending a claim. But it is important to note that the one thing that you probably would always remain liable for and couldn't transfer over would be payment of the excess, which is always, unfortunately, the obligation of the insured.
PI insurance is written on a claims-made basis, meaning that the insured must have a policy in force on the date that the insured first becomes aware that a claim is being made, not on the date of the event, as this is the case with insurance written on a claims occurring basis. Sophie Grace Compliance's Sophie Gerber says PI claims can become quite complex if significant time has elapsed between the event and the claim associated with it.
There can be quite a significant difference, especially if there's investment losses which have been caused by actions which have happened a couple of years prior, but the claim isn't made until a few years later. It's the policy that you have in place when the claim is made, which, is probably a good idea to try and keep the same insurer for that reason, because the next insurer is picking up a lot of risk in terms of your previous conduct, which they don't have oversight of. I think that's what causes a lot of problems in terms of placing cover as well, the way that regime's running.
Miller emphasises the importance of remaining aware of PI policy expiry dates in relation to notifying potential claims.
It's therefore of utmost importance that the insured notifies any claim or circumstance before expiry of the policy period, as doing that after the fact, if you forget or just don't manage to get your claim or circumstance notified, would mean that it would be excluded under that policy or any subsequent policies.
Run-off cover provides advisors with continuing PI cover for a period of time after their circumstances change. If they leave the industry, change licensees, or apply for their own licence, for example. Some PI insurance policies will provide automatic run-off cover up until the end of the policy period of insurance, even if the policy is cancelled during the policy period. While run-off cover is not mandatory under current legislation, Gerber highlights its importance for maintaining continuity of coverage.
So if you're changing policies, or you're moving from being under a dealer group to getting your own licence, there is going to be certain run-off for advice that you've given under the previous dealer group, and how that's going to run off, who's going to wear the risk of those clients, especially if you're going to transition clients from one licence to another licence. Insurers are going to ask questions about how that's going to work, whether there's going to be some sort of cooperation from your current dealer group, transition of the files. Run-off cover is also a big thing in terms of if you're leaving a practice. So if you're shutting down a business and you're retiring, they want to know how they're going to get access to the documentation, where are you going to be, how are they going to be in touch with you.
PI insurance for financial advisors is regulated under ASIC's RG 126, which took effect on 27 November 2007. Miller explains that RG 126 provides guidelines on how ASIC administers the compensation requirements under Section 912B of the Corporations Act.
Section 912B of the Corporations Act requires that the licensee have arrangements in place to compensate retail clients for losses that they sustain as a result of breaches by the licensee and its authorised reps under the Corporations Act, and particularly Chapter 7. Professional indemnity insurance provides cover for breaches of professional duty, as well as for fraud and dishonesty and negligent acts, errors and omissions, and so goes a long way in helping licensees to meet these obligations.
RG 126 sets out minimum PI cover requirements for licensees in order for the policy to be considered adequate. These include, but are not limited to, amount of cover, scope of cover, exclusions, persons covered, automatic reinstatements, excess and deductibles, external dispute resolution or EDR scheme awards, and approved product list switching. ASIC stipulates that PI insurance should cover a reasonable estimate of the client's potential losses. Miller emphasises that RG 126 only outlines minimum coverage requirements.
It's up to each licensee to ascertain and ensure that the limit held would be adequate for the purposes of their business, particularly where they had a large amount of wholesale client exposure as well, and that also there are higher limits that are required under other regulatory guides, for example, in relation to managed discretionary account services.
PI insurance policies must also cover the licensee against loss or damages suffered by retail clients due to breaches of obligations under the Corporations Act by the licensee and its representatives. This obligation extends to liability for fraud and dishonesty by directors, employees and representatives, as well as EDR scheme awards. Gerber says ASIC provides guidelines on what cannot be excluded from a PI policy so as to maintain the efficacy of the cover.
You can't exclude awards from an external dispute resolution scheme, so either the Financial Ombudsman Service, FOS, or the Credit and Investments Ombudsman. So if they make a finding against you, the PI insurance should cover that, subject to you paying your premium. You can't exclude loss caused by the conduct of your employees. You can't exclude from the policy the fraudulent and dishonest behaviour of directors, employees and representatives. You also can't exclude claims from misrepresentation about your services, and then there's other sorts of awards imposed by ASIC or any other state tribunal which have to be able to be covered by the PI insurance as well.
RG 126 states that as a minimum requirement, policies must cover the acts of the licensee and all of its representatives, either under the licensee's policy or a separate policy taken out by the representative, provided that the representative has contractually indemnified the licensee. Policies must also include at least one automatic reinstatement, meaning that if the limit of the policy is exceeded before the expiry date, the limit is reinstated in order to cover any further claims. Automatic reinstatement is not required if the limit is already twice that of the minimum required. RG 126 also states that advice businesses must ensure that their PI policy excess is at a level that the business can confidently maintain as an uninsured loss. Gerber cautions advisors not to expose themselves to unnecessary risk in order to minimise the cost of cover.
If you're a one-person advice licence, $50,000 to pay PI insurance excess is going to be a lot of money. So if that's the case, then your policy isn't framed rightly, but there's always going to be that temptation to increase the excess beyond what you can bear to reduce the policy premium that you can bear month to month. So I think that's one of the major risks.
ASIC also stipulates that PI policies should contain sufficient cover for awards ordered by EDR schemes, such as the Financial Ombudsman Service, or FOS, and the Credit and Investments Ombudsman, or CIO, formerly COSL. Policies must also provide cover where an advisor moves a client from a product or fund that is not on their APL to a product or fund that is on their APL, that is, switching products or funds. ASIC considers this a key area of potential loss for clients. There are a number of standard exclusions across different PI insurers, although the names and scope of exclusions may vary. Some of the more typical exclusions include advice on products not on APLs, tax advice, product failure, and high risk or complex products. Miller says most insurers would exclude coverage for action relating to advice on products not on a licensee's APL.
Or it's also called a non-approved products exclusion, and they would typically exclude cover for claims arising from advice given on products which are not on the insured's approved product list. You should typically also check that this exclusion doesn't exclude cover for legitimate switching cases, which obviously is a requirement under RG 126, because that's something that insurers sometimes aren't mindful of under that exclusion.
Financial advisors who register as tax financial advisors may need to check that their PI insurance covers them for this type of advice and have the policy amended accordingly. Gerber explains that insurers will generally exclude coverage of a product issuer in the event of a product failure.
Product failure in this context means if you're the product issuer, it won't cover you if your product's just completely tanked and you've not invested the money properly. The same in terms of the application to an advisor base. It doesn't apply if you've doesn't refer to a situation where you've invested in an inappropriate product.
Miller says many insurers are reluctant to cover investment activities that they perceive to be high risk.
Would include activities such as managed discretionary account activities or more complex products such as structured products or highly leveraged products. Some insurers would just rule those as completely outside of their risk appetite, and they would just apply a total exclusion, which obviously isn't ideal or even satisfactory for most clients. Other insurers would be prepared to cover these activities, but would probably want to impose a higher excess and possibly again restrict the cover provided. It just really depends on the individual insurer's appetite as well as the extent of and the nature of those activities.
Considerations for financial advisors when managing PI insurance cover include securing a policy at a reasonable price, managing marketing compliance, renewing cover as early as possible, ensuring the cost of ASIC investigations are covered, and establishing an effective client complaint process. Gerber points to transparency as a key aspect of successfully negotiating reasonable PI insurance premiums with insurers.
What we suggest is providing them as much information as you can rather than just responding to the form. Examples of your SOA, examples of the files that you keep, examples of your emails with clients, examples of your marketing material, because when you're an insurer, you put everyone in the same bucket until they distinguish themselves. And you need to distinguish yourself in a positive way.
Gerber says marketing checklists are important to help ensure that advisors don't attract any unwanted attention from ASIC for issuing misleading content in breach of the Corporations Act, National Credit Act, or ASIC Act.
We have a standard marketing checklist that's in place, which covers all the certain requirements that marketing has, the basic ones like putting your AFSL in place, putting your AFSL number on, your ABN, putting a disclaimer. Sending through that material with an accompanying checklist is really important.
Miller suggests that licensees begin the process of insurance renewal as early as possible.
And to allow yourself time to secure renewal terms as well as alternatives from other markets, other insurers in the market. It's also important to appoint an experienced broker with experience and knowledge of the financial sector markets.
ASIC announced in July 2015 that it would use its power, effective immediately, to recover the cost of any investigations that lead to a successful civil proceeding or prosecution. Advisors should check with their insurer that their current PI policy covers such expenses, and if not, whether they can obtain a policy extension. Finally, Gerber highlights the importance of having an effective client complaint process in place to minimise the escalation of problems.
If someone's upset with you, the raw moments are in the beginning phases. If someone's lost money, they're going to be upset right from the beginning. So you need to have a process in place to be responding to them in a professional way, and having someone review your correspondence as well, I think, is really important. Either, someone internal or external.